All right, let's get right into it. We're about to pull back the curtain on how professional traders actually look at the market, and I'm willing to bet it's not what you think. So, let me just ask you this. What if almost everything you've been told about trading is, well, kind of wrong? You know, the idea that you have to find the perfect strategy, or that you need to somehow predict the future, that it's all just a guessing game? Yeah, there's a really good chance that's all a myth. Because pro trading, it's not about guessing at all. It's about stacking the odds in your favor.
You see, the single biggest lie in this entire industry is the idea that you can be perfect, that there's some flawless, holy grail strategy out there, or that you can magically guess what the market's going to do next. Let's just tear that whole idea apart, shall we?
This right here really shows the huge difference. On one hand, you've got the beginner mindset. It's all about chasing perfection, trying to guess every single market move, and being obsessed with having a super high win rate. But then you look at the pros. They know the market is chaotic. They're not guessing, they're just observing patterns that tend to repeat, and they're playing the odds. They know that managing their risk to reward is where the real money is made.
And if you need proof, just look at this. Jesse Livermore, an absolute legend, had a win rate of only 30%. If you just looked at that number, you'd think he was a terrible trader. But here's the thing. When he was right, he was so right that his wins would just dwarf all his losses. This proves it, plain and simple. It's not about how often you win. It's about how much you make when you're right versus how little you lose when you're wrong.
Okay, so if we can't predict the future, what are we supposed to do? Well, we look at what's actually driving the market, and that's people, just plain old human beings, and that is where we find our edge.
The whole professional approach is really based on this idea called behavioral finance. Now, I know, that sounds super fancy and academic, right? But it's not. All it really means is that we're watching for human behaviors that just keep happening over and over and over again in the markets. And why do they repeat? Because markets are and always have been run by people.
And for thousands of years, what has driven human psychology? The same basic emotions. We're talking about greed, fear, the fear of missing out, or FOMO. These feelings, they don't change. And because the very same emotional creatures are behind all the buying and selling, their behavior creates patterns on the charts that you can spot. Your job isn't to guess the future. It's to recognize the past repeating itself.
All right, enough theory. That's all great, but let's make this real. Let's actually get our hands dirty and see if we can spot a random pattern right now on a gold chart. I want to show you just how simple this can start.
Okay, the most important thing here is we have to be specific. So first, we define when and how we're going to look. Let's pick the New York Open, because that's when a ton of trading happens, and we'll use a 1-hour chart. Simple. Next, we define exactly what we're looking for. Let's keep it basic. We're looking for a break of a key price level, followed by the price coming back to touch or retest that same level. That's it. That's the entire pattern we're observing.
Now, this next part is absolutely crucial. Seeing a pattern is one thing, but that's not a strategy. A professional needs a strategy, and a strategy is really just a pattern with a strict set of rules wrapped around it. This is what turns a random observation into something you can actually test and repeat.
So here's how we do it. We add specific rules. We decide our entry trigger is a 15-minute candle closing in our direction after that retest. We place our stop loss, our safety net, just on the other side of that level to protect us if we're wrong. And here's the secret weapon. Our profit target is set to be twice as big as our risk. This 1-to-2 risk-to-reward ratio is everything.
So let's just look at a couple of random tests, okay? On the first trade, oops, the price turns against us and hits our stop loss. That's a loss of 1 unit of our risk, what we call a -1R. But on the second trade, it goes our way, and bam, we hit our profit target. That's a gain of 2 units of risk, or +2R. So we had 1 win and 1 loss. With that tiny little test, our win rate is 50%. Now, a beginner might look at that and go, 50%, that's terrible. That's just a coin flip. But oh man, they would be missing the entire point.
So this leads us to the most important question of all. With these rules in place, is a 50% win rate actually profitable?
And the answer is a huge, resounding yes, absolutely. Just think about the math for a second. If you lose $1 every time you're wrong, but you make $2 every time you're right, you could be wrong more often than you're right and still make money. A 50% win rate with this setup means you are consistently profitable over time. This is the simple math that the pros live and die by.
But listen, finding a pattern that looks good is just the very first step. This next part, this is what truly separates the amateurs from the professionals. This is the real work.
The real work is testing. A pro is going to go back and test that strategy at least 100 times to get real, solid data. Then they become a detective. They analyze the results to find weaknesses. They might find something like, you know what? My biggest losses always seem to happen on Mondays. So they refine the plan. They add a new rule. I will not trade this strategy on Mondays. And then what? They go back and test it all over again to prove that the change actually made it better. This cycle of test, analyze, refine, repeat, that's how you build rock-solid confidence in a strategy.
So let's just end with this because it sums it all up. Professionals do not have a crystal ball. They are not trying to predict the future. They are more like scientists. They identify a pattern that has a high probability of working out, they build a rock-solid plan with a mathematical edge, and then they just follow that plan with total discipline. So the question for you isn't, can you predict the market? The real question is, can you follow your own rules?